The final step in the budgeting process is to do a budget variance report. And that's where we get to the end of the period once we've done our budget and we look at how we actually went by comparing our actual result, minusing away our budgeted result, and that'll give us a variance. So the format is we have a column for the item that we did a budget for, so in this case cash sales. We look at what we actually budgeted for, so in this case we planned for cash sales of 9,000. We then look at what did we actually achieve. We actually achieved sales of 10,000. That's a variance of 1,000. And with the variance number, we always express that as a positive. We don't need to call it a negative and figure out whether it's good or bad in this column. And that's because we've got this extra column which says favorable or unfavorable. So if we actually achieved $1,000 more sales than planned, we would call that favorable. Collections from debtors, we budgeted to pay them, get from them 11,000. We actually only got 8,000. That's a variance of 3,000, and that would be an unfavorable result. Wages expense, wages were budgeted for $1,500. They were $2,500. They've actually been higher than we planned by 1,000, so we would call that unfavorable. So looking at whether something's favorable or unfavorable, it's not a case of something being more than or less than. What we say is it's actually where the actual for a favorable variance, the actual result is better than the budgeted result. Conversely, for an unfavorable variance, that's where the actual result is worse than the budgeted result. So we don't say more than or less than because it's going to be different for different items. So for items that are cash inflows, revenues, or profits, when your budgeted result is higher than your actual, that's a favorable, unfavorable variance. And when your actual result is higher than your budget, we'll call that a favorable result. So looking at some examples, we expected to collect $15,000 from debtors. We actually got 18,000. That's a variance of 3,000. That is going to be a favorable result. And the reason is we actually collected more cash than we budgeted for. Credit sales, we budgeted to have credit sales of $25,000. We actually only had credit sales of $21,000. It's a variance of 4,000. We're going to say that's an unfavorable result. And the reason why is the budgeted figure was more than we'd actually achieved. Net profit was higher than we planned, so we call that a favorable result. But looking at items that are cash outflows and expenses, the opposite applies. When the budgeted result is higher than actual, we say that is the favorable outcome. And when actual is higher than budget, that will be the unfavorable outcome. So in this case, if payments to creditors were expected to be 8,000, but they actually were 10, we would call that an unfavorable variance because we have spent more money than we budgeted for. If we had the insurance expense, the budget was $2,400. It was actually only $1,800. That's a variance of 600, and that would be a favorable result based on the fact that the budgeted amount was higher than actual. Likewise with wages, wages were actually lower than we'd planned, so that's classified as a favorable result. We can also express it as a percentage, and what we do is we take the variance and divide it by the budgeted number, not the actual, we do the budgeted. So looking at these numbers here, we would take these variances here, and for each item we divide it by its budgeted result. So taking collections from debtors, that would be 20%, payments to creditors would be 25%. We can do a budgeted variance report for the cash flow statement and the income statement. And here's an example of the cash flow statement. We just go through line by line, section by section, going through each item. Likewise with an income statement, just trying to figure out where the any significant problems are. And the most important thing with a budget variance report is that the process doesn't end just from once we've done it. What we want to do is once we've done the variance report, identify any problems. So what were the main issues that we had, take any action to fix them, and then develop a new budget. And then we've got a second budget for period 2. So once period 2's happened, we want to do a budget variance report to compare our actual results with our budgeted results. We want to identify any significant problems. We want to take corrective action to fix them. And then we want to develop a new budget. Then period 3 will happen, and we'll keep doing it each period, perform a budget variance report, and then identify problems, fix them, and then develop a new budget. So rather than just doing it once a year or 6 months, we want to do budgeting as frequently as possible. So rather than waiting till the end of the year, if an item, say bad debts, was a problem in about February or March, we don't want to wait and measure that until the end of the year because we can't take corrective action until many months later, and bad debts have caused a problem for the whole year. So what we'd be better off doing is, if bad debts are a problem back here, we'd be better off doing a budget variance report more frequently. So if we did a budget variance report after March, we'd be able to identify any problems such as bad debts, and most importantly, take corrective action, and that way we'd be able to fix it in time for the end of the next period at the end of the 30th of June. So we should always do budget variance reports as frequently as possible. The budgeting process then, it's kind of got 4 steps. We compare the actual and budgeted results. We identify any significant variances that have affected our performance. We take corrective action to fix that. And then we do a new budget for the next period. And all that happens is we go back and we start again. So once the next period's come and gone, we compare actual and budgeted results. We identify any significant variances. We take corrective action and we prepare a new budget. So what is a significant variance? Which ones do we need to look at and investigate? There's no set figure or percentage that we can give you. We just define it as a significant variance as one which affects the firm's results and decision making. So we go back to the qualitative characteristic of relevance. If something's material enough to have affected our decision making, then we need to investigate it and take corrective action. Insignificant variances, well, again, we can't have a number and say anything above or below a certain percentage is insignificant. It's just defined as something that's small enough or not material enough to affect the business's decision making. These are the ones that we don't need to investigate. We can just focus our attention on the significant variances.